Greetings, Jonathan Camarda, and hopefully all of you are having a good late fall season. And right on cue, spooky season, right? Here we are turning the corner from Halloween into Thanksgiving, and the market's really playing a great act. Obviously, the macro backdrop, which we won't get into details, causing an overhang here that has been certainly had a bearish tone. So we'll start from the top and, as usual, kind of chisel our way into strategies for you. So again, earnings season generally been pretty positive, some mixed, a mixed bag to a certain extent, but generally pretty positive. However, the market has thrown the baby out with the bathwater. If you don't have great numbers, you're thrown right out the 11-story window. And even if you have decent numbers, you're still hit pretty hard. So we don't usually get into individual stocks on this show, but we will kind of mention the aforementioned Magnificent Seven. And we talk about the S&P 500 year to date, which, by the way, no longer double digits, in mid-single digits, in that 7% range. And the equal weight, meaning not the cap weight, right? The large, pretty stocks that are driving it up, if you just equal weighted them, is actually negative, just like the Dow, which is down 2% year to date. So as you look at your own strategies and such and your risk exposure, we've kind of had the dial where we needed it to have it. So the Magnificent Seven, of course, are your alphabets, the artist formerly known as Google, your Apples, your Amazons, Microsoft, Meta, NVIDIA, and Tesla. Right, so those stocks there on the NASDAQ and S&P have had a higher weighting. And of course, the AI-driven trade from early in the spring drove some of these indices up. Now, a lot of the clients, especially the ones I deal with, have representation or had in most of those stocks, all of those stocks, but perhaps not to the heavy weighting as some of those indices. And over the last month, you're seeing why, right? Again, those are also dragging down those indices on a month-to-date basis. Now, a couple reasons why. We'll get into that, and then also explain why, even though it's spooky season, it's not all doom and gloom seasonally. So let's see where that takes us. First off, we talked about this early in the year. Early in the year, after a strong 2022, the U.S. dollar versus the global basket of currencies, main ones that I look at, of course, euro, yen, looking at the Canadian dollar, Aussie dollar, to a lesser extent, the British pound. But, early in the year, the dollar was weaker against those, especially the euro. That's the main component there. And we saw a surge in late July, right? Rates went back up. The dollar surged. In fact, for like 11 straight weeks of uptrend versus global currencies. And to put that into perspective, that hasn't happened in a decade. And here's the deal, people. High rates, high dollar. Of course, you see the bond market that has collapsed as well. That's why you see Jerry Powell and the Feds talking about how the bond market's done their job. There is a potion out there. They have to be a little careful, though, because it might not necessarily be a panacea, it doing its job. Once that meows out of the bag, we had the latest GDP numbers coming in 4 or 5%. Now, a lot of people think that's artificially inflated with some government numbers. We shall see how steep the drop is. But the Fed has shown propensity to have their foot on the brake pedal, especially with the global macro picture, right? We have a couple of wars or conflicts going on. Fed coming up is probably not going to hit the gas pedal on a rate hike. We shall see. Now, here's the situation with that aforementioned dollar, going back to the currencies. As long as the dollar keeps surging, rates keep going up, which as clients, we've been taking advantage of that, especially in our active capital preservation strategy. The market is going to hit headwinds. If the dollar has a reprieve, okay, then it gives some breathing room perhaps for a year-end rally. I put that in quotes, right? Be a little tempered. The dollar has stalled in its uptrends, its recent uptrends versus the aforementioned currencies. But again, on a global basis, still looking like it could finish strong for the year, which would not be good for stocks. Again, there's no guarantee in that. Coinciding with that, this is generally a very, very critical juxtaposition. The handing off of the baton from late October to early November, those first few days, usually a seasonally bullish effect. In fact, last year, the 2022 bear, or at least the first component of the bear, we shall see, hit the skids in mid-October, late October into November. And then December, we saw that the market had bottomed and taken off into 2022, especially on the tech side, the AI side, right? So here we are again, as I look at put-to-call ratios, right? The other component, we're looking at currencies. okay? We're looking at options. We're looking at institutional option play. Put the call ratio went to almost feverish, not quite feverish, 0.85, meaning a lot of sellers versus buyers institutionally. Broke through back down to 0.75 last week. We shall see seasonally what that means. As again, more put to calls, more institutional selling. That's a bet on bearishness. But again, a lot of times when it spikes, either too high or when it goes too low, complacency, the market tends to revert. We shall see. Markets pulled back about 6.1% here over the last several weeks in 2023. That 6.1 to 7.1 has been the average correction this year in a pullback before we resumed an uptrend. We shall see, though, again, with a lot of the things going on, from that standpoint. Now, like I said, we have a lot of history here. Pre-election year, usually into November, bullish, bullish and also extreme selling. But again, with the currency moves, the global situation, things falling apart, especially in Europe, doesn't bode well for the euro. And of course, the dollar versus the euro, that starts to go back up again. Could be a tough sledding. So within your strategies, you'll see, or the last thing I wanted to mention on equities is small caps, right? The Russell 2000 just getting lumbasted. In fact, all of the indices year to date have made a run for the highs of late 2021. None of them have reached them. The NASDAQ, the S&P, and Dow all tried, and they failed short. So we're watching that as well. The Russell 2000, they never got out of bed. They just hit the snooze button. Couple of reasons again, right? Smaller companies. Let's think about it. All right, let's unwrap this. High rates, right? High borrowing cost. Smaller companies need to borrow. They don't have those rich fortress balance sheets. That's not good, right? Think about consumer debt, which we already went over. We're not going to get into that doom and gloom, not this time. Think about the rates on credit cards for folks out there. Same thing with companies. Smaller companies definitely getting hit with the cost of capital. And then also a lot of these regional banks, by the way, are clustered in there as well. So if you ever look in Orion, not many people do this deep, and you look at actually your asset class exposure, you'll see you have very little exposure to small caps in general, and that's one of the reasons where, again, we have not seen any bit of daylight in that area at all. With that being said, as we roll into a very busy earnings week again, we're going to mix in some Fed. Hopefully you guys had a good football weekend by the time you're watching this. Maybe your team won, and we'll see again if the Bulls can get the ball down the field as well. As always, stay frosty. I know it's pretty hard. I think it's supposed to get cool midweek. Not that I'm playing a meteorologist, although I may be more accurate than most of your local guys and gals. We'll stay eternally vigilant. Until next time, Jonathan Camarda. Let's keep our eye on the ball.